And joining us now to discuss the inflation report is Jason Sorens, Senior Research Fellow at American Institute for Economic Research. Good afternoon, Jason. So inflation ticked up to 2.4%, slightly below estimates. Can you give us what stood out to you in this report?
Yeah, so that was 2.4% over the last year, but if you look at the month-to-month inflation rate, it was just 0.1%. So on an annualized basis, about 1.2%. So really, inflation has been at or below the Fed's target of 2% for the last 3 months. And in fact, CPI slightly overstates inflation. So if you look at the Fed's preferred measure, PCE inflation, you would expect that to come in even slightly lower than that. So overall, this is a cool inflation reading. It makes it more likely that the Fed will cut interest rates, not at this meeting, but possibly the next one or the one after, and market expectations of that have risen.
To what extent do you think, Jason, are President Trump's tariffs feeding into consumer prices?
Not much yet. And in fact, most of the tariffs, of course, have not gone into effect or have been suspended. But we may be seeing them already in groceries because these are perishable goods. That is the first place we would expect to see some tariffs show up. And so we did see that 0.3% monthly inflation reading on groceries, which is a little high. But overall, goods, including automobiles and consumer durables, actually fell in price over May, and most of the inflation came from services. So really, tariffs have not shown up in the inflation data yet.
You know, Jason, I know some companies at least are holding off on price hikes. Why do you think that is? Do they still have plenty of inventory, or because of competition, or maybe they're worried that the consumer might just go somewhere else? What is the answer?
Yeah, so companies built up inventories as these tariffs were being announced. And so they quickly onshored a bunch of goods in March and April. And as a result, they are selling down their inventories now. And for that reason, they don't need to raise prices yet. And again, for most goods, for most countries, that rate is now 10%, which is a little higher than it used to be, but is certainly much lower than some of the extremes that have been announced on April 2nd.
Well, I would imagine their inventory is limited, right? I mean, will tariffs push inflation back up if businesses start to pass on the costs?
It's likely that we will see some growth in inflation as a result of tariffs, especially if some of the higher tariffs come back into force. Remember, they're only suspended for 90 days, and we've got something like 50 more days of that left. So it's certainly possible that these numbers will show up in inflation. Now, you would expect tariffs mostly to affect relative prices rather than the price level. By that, I mean that the tariffs will raise the cost of goods that can be traded, right? So food, manufactured goods, that is where you should expect inflation to show up. But you wouldn't expect it to show up in services, education, healthcare, restaurants, food service. In in most economist models, tariffs don't affect the overall inflation rate unless they decrease the productivity of the whole economy. And that is certainly possible because remember that tariffs are hitting business inputs as well. So they're hitting steel, aluminum, for example. They're hitting things that are used in business production that could make businesses less productive, and that would cause inflation to go up. But you should expect it first to hit those tradable goods sectors like food, agricultural products, and manufactured goods.
Okay, so during this inflation battle with the Fed, you probably heard of the statement that the Fed is usually behind the curve, right? And Trump has called the Fed to cut interest rates 1 percentage point. Do you think the central bank should do that?
Well, I think it's probably not helpful for the president to be calling for it because, if anything, that may make the Fed more resistant to changing whatever course it's on because it doesn't want to seem as if it's responding to political pressure. But I do think that increasingly we're seeing that inflation is cool, and that monetary policy is tight compared to where it needs to be. So I do think President Trump actually has a little bit of an argument here that the Fed needs to start thinking about cutting rates. They probably want to see another month of low inflation readings before they start to do that. And right now, the market does not expect them to cut until September, but there is a very high likelihood that they'll cut by 25 basis points by September.
Okay, by your estimate, how likely is it that do you think the Fed will meet its dual mandate in the current environment?
It's tough because if you see tariffs push up inflation at the same time that the labor market is cooling, that makes it really difficult for the Fed to keep unemployment low and keep inflation at 2%. What you might see is that the Fed continues to cut rates, returns to cutting rates, even if inflation is slightly above its target, under the idea that it will come back down, that it could be a temporary inflation if it's just being caused by tariffs. And so as a result, especially if the labor market looks soft, we may see a little bit more inflation as we get into summer and early fall.
All right, I'll just ask you one more thing before we go here. Are we going to see an environment where inflation is still above target, but economically speaking, it's not so healthy? There's weakness in the economy?
Well, of course, stagflation can happen, right? Where you have both high inflation and unemployment or slow growth. And we had that in the 1970s. And typically that happens when you have what's called an adverse productivity shock, right? If something hurts the productivity of the US economy in the 1970s, you had oil shocks. Right now, you've got tariffs. That certainly does risk the possibility that you could have even a recession along with high inflation, and that would be obviously hugely negative for the American worker and the American consumer. But at the same time, I think there are some real strengths in the U.S. economy right now. We have significant productivity growth in the information sector, in artificial intelligence, in things like automated cars, and I think what we're going to see here is that if we can get policy back on track to low tariffs, deregulation, tax cuts, and smaller federal government spending, then we'll see the productivity of the American economy pick up, and we'll see positive growth and low inflation.
Well, all right, Jason, good to talk to you today. Thank you very much.
Thanks for having me.